Okay, so you're actually considering buying a mall? Not just curious how the business works in theory. You've got a real listing in front of you, a broker has sent over a package, and somewhere in the back of your mind, you're wondering whether this is a genuinely smart move or the kind of decision people write cautionary business school case studies about 10 years later. Most content about shopping malls tells you the history and the theory. This one is different. By the end of this video, you're going to have an actual checklist. Strengths to look for, weaknesses to watch for, specific things to do, specific things to never do, and a numbered list of due diligence questions you can genuinely use if you ever sit across the table from a mall broker. Let's build it from the ground up. First, the real numbers, because everything else in this video only makes sense once you understand what you're actually paying for. Let's build a concrete example and follow it through the whole video, so none of this stays abstract. Say you're looking at a 700,000 square foot regional mall in a mid-sized metro area. 3 anchor stores, roughly 90 smaller inline tenants, built in the late 1980s. A property like this, depending on occupancy and anchor health, might be listed anywhere from $40 million on the distressed end to well over $150 million if it's a genuinely strong performer with high sales per square foot and a waiting list of brands wanting in. That gap, 40 million versus 150 million for buildings that might look nearly identical on a drive-by, is the single most important thing to understand before you do anything else. You are never buying square footage. You are buying a specific measurable income stream, and the price should be a direct multiple of that income, not the size of the parking lot. Building new instead of buying is a different conversation entirely. A large-scale mall construction project, land, structure, parking, utility infrastructure, and permitting can run into the hundreds of millions of dollars before a single tenant moves in. And very few private buyers build malls from scratch anymore, precisely because that math rarely works in a retail environment where online shopping has permanently changed how much foot traffic any given square foot can expect to capture. For almost everyone watching this who might genuinely consider this asset class, buying an existing operating property is the realistic path, which is exactly why the rest of this video focuses on evaluation and operation rather than ground-up development. Now, ownership structure, because this determines which kind of buyer you actually are. If you're an individual or a small investment group, you're most likely looking at a direct private purchase of a single property or a small portfolio, financed through commercial real estate debt, where you'll personally be responsible for property management, leasing decisions, and capital improvements. If you're looking to gain exposure to this asset class without operating a physical property yourself, publicly traded mall REITs let you buy shares in companies that own dozens or hundreds of these properties, spreading single property risk across a much larger portfolio at the cost of having zero control over which individual assets are bought, sold, or renovated. For our 700,000 square foot example, we're talking about a direct private purchase, because that's the scenario where every decision in this video actually matters to you personally. Let's talk about what genuinely works in this business, the real strengths, because this industry gets a lot of doom and gloom coverage that isn't the full picture. Strength number 1, diversified income streams. A well-run mall isn't earning money one way. It's earning base rent, percentage rent, tied to tenants' sales performance, common area maintenance reimbursement from tenants, kiosk and cart rental in high traffic corridors, parking revenue in dense urban locations, and advertising and event space rental. On our example property, if base rent across inline tenants alone generates something like $12 million annually, percentage rent from strong performing stores can meaningfully add on top of that during a good retail year without you doing anything differently operationally. That's a genuine structural strength few other real estate asset classes offer at this scale. Strength number 2, percentage rent upside. Because leases are frequently structured with a base rent plus a percentage of sales above a certain threshold, you directly benefit when your tenants do well without having to renegotiate anything. A strong holiday season for your tenants is a strong quarter for you automatically. Strength number 3, redevelopment optionality. Malls sit on enormous, often centrally located parcels of land. A struggling mall in a growing metro area isn't necessarily a dead asset. It's frequently a redevelopment opportunity, converting underused anchor space into apartments, medical offices, or entertainment venues. And that land value can end up being worth more than the retail income the property currently generates, giving you a genuine exit strategy even if the retail side of the business struggles. Now, the weaknesses, and this is where a lot of buyers get into trouble because they read the strengths and stop paying attention. Weakness number one, anchor dependency. On our example property, if one of your three anchors is paying below market rent, sometimes as low as a fraction of what your inline tenants pay per square foot because that lease was signed decades ago, you don't get to simply raise that rent whenever you want. That anchor stays locked in at that rate for however many years remain on their agreement, and you inherit that deal exactly as written the day you buy the property. Weakness number two, co-tenancy clause risk. And this is the one that catches new buyers off guard the hardest. Many leases contain clauses stating that if a major anchor closes or if occupancy in the mall drops below a certain percentage, smaller tenants are legally allowed to pay reduced rent or in some cases walk away from their lease entirely. This means a single anchor closure doesn't just cost you that one tenant's rent. It can trigger a cascade of rent reductions across dozens of other leases simultaneously, sometimes without you finding out the full scope until you're already reviewing lease files after the anchor has already announced its closure. Weakness number three, a high fixed cost floor. Utilities on a building this size, security staffing, common area maintenance, property tax on what's typically a large and valuable parcel, none of that shrinks when occupancy drops. If your occupancy falls from 92% to 78% after losing an anchor, your operating costs stay almost exactly where they were, while your income has meaningfully declined, and that gap comes directly out of your margin. Weakness number four, e-commerce substitution. This isn't going away, and it isn't uniform. Some categories, restaurants, gyms, entertainment, medical offices, are genuinely resistant to online substitution because they require physical presence. Apparel and general merchandise are far more exposed. A mall that's still heavily weighted toward traditional apparel retailers in 2026 is carrying more structural risk than one that's already diversified into experience-based and service-based tenants. Now let's turn this into actual practice. Here are the do's, specific things to actively pursue if you're evaluating or operating a property like this. Do diversify your tenant mix deliberately, beyond apparel, toward restaurants, entertainment, medical and dental offices, fitness, and personal services. In our example property, if inline tenant categories are currently 70% apparel and general merchandise, that's a red flag worth addressing through your leasing strategy immediately after purchase, not something to leave for later. Do negotiate co-tenancy clause caps whenever you're signing new leases or renewing existing ones. A cap that limits how many tenants can invoke reduced rent simultaneously, or that requires a longer grace period before reduced rent kicks in after an anchor closure, meaningfully limits your downside exposure during exactly the scenario that hurts most. Do build in mixed-use flexibility from day one, even if you have no current plans to redevelop. Zoning that permits residential, medical, or office conversion on at least a portion of the property gives you genuine optionality later, and that flexibility itself adds real value even if you never use it. Do stress test your specific property against a single anchor closure before you buy, not after. Pull the co-tenancy language for every major tenant lease during due diligence. Model out exactly how much rent is legally at risk if your weakest anchor closes within the next 5 years, and price that risk into your offer. And the don'ts, because these are the mistakes that show up again and again in mall acquisitions that went badly. Don't overpay based on headline occupancy alone. A mall that's 92% occupied sounds healthy, but if a meaningful share of that occupied space is anchor square footage, paying a fraction of market rent, and a growing share of your inline tenants are on short-term leases at discounted rates just to keep the space filled, your actual cash flow can be far weaker than the occupancy number suggests. Always ask for rent roll data broken down by tenant, not just a headline occupancy percentage. Don't ignore CAM structure red flags. If common area maintenance charges have been underbilled relative to actual costs for several years, running the property at a loss on shared expenses that the previous owner simply absorbed, you'll inherit that gap the moment you take over, and raising CAM charges on existing tenants mid-lease is far harder than setting them correctly from the start. Don't assume anchor leases will renew at market rate. Many anchor leases include renewal options at the original below market rate, sometimes for multiple additional terms, meaning even if the anchor stays for another 20 years, you may never actually capture market rent from that space during your entire ownership period. Read the renewal terms, not just the current term, and don't underestimate deferred maintenance in an aging property. A structure built in the late 1980s is approaching or past the age where major systems, roofing, HVAC, Parking structure concrete needs significant capital investment, and a seller motivated to sell often has every incentive to defer exactly that kind of spending in the years leading up to a sale. Get an independent structural and mechanical inspection before you close, not a report the seller commissioned themselves. Now let's revisit a real case study, briefly, but this time as a diagnostic exercise rather than just a story. Rolling Acres Mall in Akron, Ohio opened in 1975 and grew to over 140 stores with 5 department store anchors at its peak, reportedly around 98% occupied in the mid-1990s. If you were evaluating this property at that peak moment using the checklist we just built, what would you have actually found? On strengths, genuinely strong, high occupancy, multiple anchors, diversified tenant base for its era. On weaknesses, this is where the warning signs were sitting in plain sight if anyone had gone looking. 5 different anchors meant 5 different sets of co-tenancy clauses layered across the property, a genuinely fragile structure even at 98% occupancy, because losing even 1 or 2 of those anchors could trigger co-tenancy provisions across a meaningful share of the inline tenant base simultaneously. Newer, renovated competing mall opening nearby a few years later is exactly the kind of regional competition risk a careful buyer should model before purchase, not treat as an unforeseeable surprise. And once the first anchor left and a second was rebranded twice within 2 years before finally closing, the co-tenancy cascade we described earlier as a weakness played out exactly as the lease structure predicted it would. By 2006, the property sold for $1.6 million, down from a valuation once well over $30 million. The lesson isn't that Rolling Acres was mismanaged in some obvious way. The lesson is that the specific structural weakness, multiple anchors each carrying their own co-tenancy risk, was identifiable at the time of peak occupancy by anyone willing to actually read the lease files instead of just looking at the occupancy percentage on the marketing brochure. Here's the numbered tip list, the concrete due diligence checklist this video promised at the start. 1. Request a full rent roll broken down by tenant, not a headline occupancy number, and calculate what percentage of total square footage is paying below 50% of the property's average rent per square foot. 2. Pull co-tenancy clause language for every anchor lease and model the worst case scenario where your weakest anchor closes within 5 years. 3. Verify CAM reconciliation history for the past 3 years to confirm shared expenses have been billed accurately rather than absorbed by the current owner. 4. Commission an independent structural and mechanical inspection covering roofing, HVAC, and parking structure condition. Don't rely on a seller-provided report. 5. Review anchor lease renewal terms specifically, not just current lease length, to understand whether you'll ever actually capture market rent from anchor space during your ownership period. 6. Analyze tenant category mix and calculate what percentage of inline square footage is apparel and general merchandise versus service, food, and entertainment categories that are more resistant to e-commerce substitution. 7. Confirm current zoning allows for mixed-use conversion on at least a portion of the property, even if you have no immediate redevelopment plans, because that optionality itself carries value. 8. Research planned or rumored competing development within a realistic driving radius, because regional competition is one of the most common triggers for the exact co-tenancy cascade that sank properties like Rolling Acres. 9. Calculate your break-even occupancy rate given fixed costs, meaning the occupancy percentage below which the property stops covering its operating expenses, so you know exactly how much cushion you actually have before a downturn becomes a crisis. And 10. Price the deal off net operating income relative to comparable cap rates for similar tier properties in similar markets, not off the seller's asking price relative to what the building originally cost to construct. So let's go back to our example. The 700,000 square foot mall listed somewhere between $40 and $150 million, and talk about what actually separates the good year from the bad year using everything we've just covered. In the strong scenario, you've applied the dues, diversified tenant mix, negotiated co-tenancy caps on new leases, maintained genuine flexibility for redevelopment, and your due diligence caught the weak points before you signed anything, so you priced the deal appropriately for the risk you actually inherited, rather than the risk the marketing brochure implied. Base rent is solid, percentage rent adds real upside during strong retail years, and because your tenant mix skews towards service and experience categories, You're structurally less exposed to the ongoing e-commerce substitution that's hurt more apparel-heavy properties. In the weak scenario, you skip the checklist, overpaid based on headline occupancy, inherited co-tenancy exposure you never modeled, and a single anchor closure 2 years into your ownership triggers exactly the cascade we described with rolling acres: rent reductions across a dozen tenants simultaneously. Fixed costs that don't move an inch, and a break-even occupancy threshold you never actually calculated before you needed to know it. The building in both scenarios might look nearly identical from the parking lot. The difference was entirely in whether the buyer did the work this checklist just walked you through. That's really the thing to carry away from all of this. A shopping mall is never just a building full of stores. It's a specific, inherited set of legal agreements, financial obligations, and structural risks that came with whatever lease terms and maintenance decisions the previous owner made, sometimes decades before you ever showed up. The strengths are real. Diversified income, percentage rent upside, genuine redevelopment optionality on valuable land. The weaknesses are just as real. Anchor dependency, co-tenancy cascade risk, a fixed cost floor that doesn't care what your occupancy rate is this month. The difference between the mall that thrives for another 20 years and the one that becomes a warehouse isn't luck, and it isn't something you can tell from a drive-by or a marketing brochure. It's whether somebody actually pulled the lease files, ran the numbers, and asked the uncomfortable questions before signing anything. You're not buying a building. You're buying a bet on a neighborhood backed by a stack of legal documents that will tell you exactly how that bet is structured if you're willing to actually read them.